Lucid Motors has been trending in popularity recently, and many people are wondering if they should buy more, sell what they have, or stand on the side given the current situation. As the market is still very volatile at the moment, we should always be careful about which stocks to pick and the exposure and timing that we want. Over the past few days, the price action of LCID or Lucid has brought the stock to around $19.84 before stabilizing back around $20.87. The short-term price action of Lucid Motors has been a bit soft on the demand side because the stock has been going through a difficult market sequence with the capital looking for opportunities elsewhere and the supply chain issues affecting the company's fundamental outlook. I think that overall, the stock is now looking for a massive catalyst ahead, and so far the market is still looking for that element to show up. Keep in mind that Lucid has been one of the most traded stocks in the market in the recent years, and I think that the stock should be considered as a relatively safe value given its products and a market outlook. For the long-term trend, it's actually interesting to see that Lucid is sitting in a support level that has been tested for many times, and despite the fact that the current context is quite difficult, it's a very good price level if you wish to enter in the stock and to hold it for a prolonged period of time. What we should always keep in mind is that no one will ever tell you to sell when the market is skyrocketing, and most people will never tell you either to buy when the short-term tendencies are not very encouraging. But if you look at the price action over the past 24 months, it's actually obvious that the stock is very close to its region of value. Now, let's dive into the technicals. The trading volume of Lucid Motors has recently been 14 million shares, compared to the average volume of 20 million shares. Over the previous 52-week period, its price fluctuated between $16.12 and $57.75. The market cap of Lucid Motors is currently at $35 billion versus the enterprise value of $58 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If it has a lot of debts or a negative image amongst shareholders, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many other companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company can generate more profit or grow faster because it may have a better management, a strong brand recognition, and a bigger online following. It is basically what makes a company unique compared to the competitors. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount. The market cap is often lower than the enterprise value because the enterprise value is less reactive than the market cap in volatile situations. If the company goes to liquidation, the goodwill would be completely gone, and the bondholders and shareholders would be left dealing with something that is far less than a balance sheet, especially if the balance sheet has a high amount of intangibles. When we compare the current price to the historical price fluctuations, the stock is 5% higher than the 1-month low, 5% higher than the 12-week low, and 29% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 94% versus a historical volatility of 64%. The put-call volume ratio is currently at 0.76. It's normal for many stocks to tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 63,000 contracts a day versus the 30-day average of 81,000. In terms of open interest, The most recent volume of open interest has been 1 million contracts versus the 30-day average of 853,000 contracts. As far as the shareholder structure goes, institutional shareholders own about 72% of the outstanding float. The biggest shareholders include Vanguard, BlackRock, and Public Investment Fund. It's relevant to understand the shareholder composition of a company, as this helps to determine if you should be holding the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. Obviously, there's a lot of exceptions to this, since many great companies are also mostly held by retail traders, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are a significant short interest in the total volume, this is a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 19% of the total float, and 57% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, and a significant portion of the short interest coming out of the dark pools, this may suggest that there are institutional positions taken to short the stock, and there would be potentials for a short squeeze. I would recommend to buy a position in Lucid, and that it should be structured to be held for the long term, between 12 to 24 months. The fundamentals of Lucid Motors remain promising, and the technical aspects show us that the downside is fairly limited as well. I would recommend to commit between 3 to 5% of your portfolio in the stock, and I would also recommend to split the allocation in batches of 30% at a time so that you can purchase more in further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into. not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.